Hello, good morning, good afternoon, good evening, people from wherever you are around the world. This is Finance Boulevard, and welcome to my channel once again. My name is Simon Obasi, and as you would know, I'm a finance person. I'm a chartered accountant, I'm an accountant by profession, but my everyday job is actually advising corporate entities and private equity firms on M&A activities. I work in one of the big four here in London. Thank you so much. Thanks again for coming to my channel. Again, as you would know, we want to promote accounting and finance through this channel and talk about everything around the economy and many more. So today, it's my privilege to share with you a conversation that I had over the weekend. Over the weekend, I spoke with founders in Nigeria through an accelerator program called the Pivot Challenge, run by my friend and a number of people. I was invited to speak to them, particularly around financial planning for startups, and share with them the process of budgeting and budgetary process as well. Probably share a few things around what they should be doing as startups, and it was also an opportunity to share with them what opportunities they have or what options they have around fundraising, where can they raise funds and stuff like that, and finally how they can pitch to investors. While it was a very tight scheduled one because I had only 30 minutes to speak about all of these things, so it wasn't really the best of times, but we delivered to the extent possible. So I thought it would be nice for me to share with a few more people some of the conversations that I had with these people. And I'm actually going to be talking to you from the same slide that I spoke to them about from. So this evening, let us talk about financial planning for startups. Now look at my screen. Yes, the basic of financial planning for startups. What are what key takeaways? What we'll be talking about in this particular episode? If you don't mind, I would say that for each of the slides that I'm going to be talking to around this, it can actually take a lot of time for us to speak on any one of the subjects. So it's very likely that all of the conversations I'm going to be having in the next 10 to 15 minutes will be focused on one slide. But I'm certain that it is rich enough for you to know what to do, and it's going to help you to run your business better or to manage the business you already run better. Or if you're planning to become a startup owner or a founder anytime soon, this will surely guide you in ways you can't imagine. So join me as you take on this race. So the key takeaways here, first and foremost, today we're only going to be talking about the first element of this conversation, which is finance basics for startups. What are the things that startups should be doing? What should they know? And all of those things. And then subsequently, we will talk about budgeting and budgetary processes. This is just a general budgetary process that you will see both for big and small businesses. It's just that it is tailored for startups. And then we'll talk about funding options. What are the options that startups do have, to raise funds? And finally, we'll be talking about pitch decks. How can you pitch to our investors, our prospective investors? So, let us delve in and discuss the finance basic for startups. What are the things that startups need to do or need to know around their finances? The first one I talk about here is around, being able to differentiate between you as a person and your business. This is one thing that most finance startup owners or founders really fail to do. They always think that, they are part and parcel of their business. You can't take them away from their business. Their business is them and they are their business. And there's nothing wrong from that. It's just that you can actually be hurting yourself by doing so. And you may ask me how. Okay, let me try to explain this. If you have spoken to any accountant in the past, you may have heard the person talk about what they call the entity concept. Now, that entity concept from an accountant's perspective says that Your business is an independent personality from you. So as a result, it means that all your dealings with your businesses are as though they're dealings with two different people. So what that means is that every single time you give money to your business, you need to tell yourself, yes, I've given money to my business, and my business either owes me or I've invested into the business. So you need to have something to keep and show that this is what happened. Now, this actually relays also coins itself to everything around, recording, keeping records of all of the activities, all of the transactions that happen within your business. Again, don't forget, you are an independent party from your business. Every time you set up a business, whether it is a private limited liability company or maybe a business name, don't forget that you are different from your business. Now, many times what startups founders do is that they commingle all of the activities. They are not able to separate their personal finances from the businesses. Now, the reality is that, or the challenge that you get to have is that many times it's assumed that all of those things are one and the same. That becomes a big problem because you're not able to tell how good or how bad your business is doing if you are not able to separate those two things. You see people who use their business funds to run their homes. You see people who withdraw money from their businesses and they are not able to account for those. You see people who actually use their everyday, like they've actually saved a lot of money from probably their employment days, and they've pumped those things into their businesses, but they don't have any set of records whatsoever. That can hurt both you and your business. Because if I want to value your business, if I want to put money in your business, I need to be able to know who exactly I'm investing in. Am I investing in you or in your business? I need to know. And then it also hurts you because the tax man is waiting. If the tax man notices that there's so much money flowing into your personal accounts, the tax man will assume that all of those things are your personal money. If the tax man notices that there's so much money flowing into your business account, the tax man will assume that those are business money and you're going to pay taxes on those. Now, it is important that you keep these things clear, right? And one of the things I tried to speak to the founders last week about is that it is important that you as a founder, you were able to have a policy around how much you pay yourself. It is not good that you stress yourself all out and you can't really say, this is how much I am paying myself for all of the commitments that I am doing. Granted, the business is yours. But you see, if you want this business to thrive, you need to be able to say, yes, this is my business and this is myself. And then the kind of question I expect that people are going to ask is, but my business just started. It is just months old. It is just years old. It won't be able to pay me. Yes, I understand. I understand. Now, if your business doesn't have capacity to pay you, it means you are actually making additional investment into that business, or you are committing additional funds into that business in the form of all of the foregone salaries that you would have earned. So who is going to pay for that salary? Who's going to pay you for all of those? Hey, wait. If you do not do all of this, if you do not really showcase how much you're going to pay yourself, all of the profit that you're making will be taxed. And then another person will come one day and want to take part in your business by virtue of maybe acquiring a certain portion of your business. What do you think is going to happen? Your valuation may not be as good. Or, you see, because you have actually commingled so much, you have actually let the business go with a lot of your money, the person will assume I'm buying everything. So it's good that you do that separation. Now, one of the advice I would give is that if your business is still in a very young age and you're thinking, what do I do this time? See, what you can do is you can ask yourself, if I were an employee, if I were employed doing this service that I'm rendering right now for my business, running the same managerial operations and all of those things, how much would I have been paid? Whatever amount you would have been paid, doing that in a caliber of business you're running, not trying to assume that you are maybe, if you were employed by maybe Amazon, or you were employed by Meta, or you were employed by Alphabet or Google, no. look around and see businesses within your confine, like that are doing around the same thing that you're doing, and ask yourself, how much would they have paid me to do this? Another way is actually to say, okay, what was my most recent salary from where I was coming from? How much was it? If, for instance, I was promoted, from the place I was working, how much would I have been earning? And then that becomes what you consider as your salary. But then again, you ask again, how much can I pay myself? Now, even though your salary could be for instance, let's take just guess an amount. Let's take £50,000 or $50,000. Even though you have said, oh, if I were employed, I would have been paid $50,000, right? But my business can only afford to pay me $10,000 at the moment. Now, what that means is that put it in there, show that it is $50,000 that this business is to pay you. But take the $10,000 and keep the remaining $40,000 as an amount that the business owes you. Don't be afraid. Do that. Because at some point, if an investor wants to come, the investor will consider that you've actually made a lot of investment, and part of the investment you've made is actually foregoing your salaries. Do you get? And then you can get that back at some point. See, in a very large private equity acquisition that I advised on, this company was a robotic entity, right, in Australia, and sometime at some point they moved to the US. One of the things that the owners did was they accumulated all of the salaries that they ought to have taken at the time they worked for that company, the two directors, and that sat on their balance sheet. So at the time when we were evaluating this, we are actually saying that they need to be paid for all of those. That is what it is. So you see, it is important that you separate your business from who you are. Separate your operations from who you are. When you put in cash into the business, record that cash has come into your business from your personal purse. When you take away cash, also do the same recording. When you don't forget to pay yourself salaries and all of those. So there are so many things we can talk about, but I think that is it for this one. Now the next one is that cash flow is everything. Cash flow is everything. You see, I didn't say cash is everything. Yes, you must have heard people talk about cash is king. But I said cash flow is everything. In fact, if I were to define it, I would have said operating cash flow is everything. And you ask me how. The reality is you need cash. So cash is important. Cash is what's going to determine how much runway you have, how many years or how many months you can operate without having to go looking for additional funds and all of those, right? Now, if you're not able to have sufficient cash that can take you to a certain runway, then there is a very high chance you're going to lose. You're going to fail. And you must have heard that probably about 80% to 90% of small businesses fail over the first 5 years. That's true. Why? Why do you think they fail? It's because there's no cash. Because if there is cash, they can continue to run. Why was Amazon able to run for over 20 years without profitability? Because there was cash somewhere. So if you know how and where to get cash to run your operations, then that's important, right? So one of the critical things you need to do is to make sure you figure out how to preserve cash. Now, how can you preserve cash? Cash can come by virtue of probably the operations that you're running. If you're having customers who are paying you, that's good. You can actually get cash from other means. You can go to investors and tell them, okay, this is what I'm doing. And then they can get committed to you and then give you funds to run. But always remember, you need to plan your cash flow. One other reason why this is important is because your valuation is often dependent on cash. Forget about all of those other things you hear that, oh, these are all multiples of these and multiples of that. Every multiple still has one denominator, which is cash flow. So every time that somebody wants to invest in you, the person is saying, what is the expected value of the amount or the present value of all of the expected cash flows I'm going to generate for investing in you? Cash flow is everything. And then the third one is that you need to manage your expenses, but more importantly, you need to grow your revenue. Every single time you talk to people around growth of their business, you won't hear somebody telling you my expenditure increased by this. Most people will tell you that my revenue grew by this number. That is a very critical element for evaluating the growth and performance of your business. Who cares about your expenses? I mean, yes, it's important. It's not like it's not important. But people will actually care about your revenue growth rate than your expenditure growth rate. If your expenditure is growing at a faster rate than your revenue, then you have a problem. However, if your revenue is growing and your expenditure is growing, there's a very high chance that your revenue will dominate your expenditure at some point. And that's why, a company like Amazon at some point broke even. So while you manage your expenditure, please find all ways possible to grow your revenue. And the next one is you need to understand the industry KPIs you are operating in. The KPIs of the industries you are operating in, and then you need to be able to track them. Now, imagine you're talking to a prospective investor and your investor asks you, what is your gross margin? And you don't know. That's a big red flag. What if the investor asks you, depending on the the industry you're working in, the investor asks you, what is your customer acquisition costs? And you don't know. What are you doing? If the investor asks you or the prospect asks you, how many customers did you acquire last year, 2 years, this month, last month, very recent periods, and you don't know, what are you doing? What is your churn rate? And you don't know, what are you doing? So you need to understand your industry. What are the critical KPIs that need to be measured in your industry? And then keep a track of all of those. Where is your most money coming from? Who are the supplier, the customers that are giving you the greatest money? Are they people the top or the bottom? Focus on whichever one is giving you the most money. It is important that you track your KPIs. And then we talk about controls. Controls. Very important. What do I mean by controls? These are some of those things you put in place, the systems you put in place to ensure that you are not robbed, that you are not like probably people and employees and everyone does not take you for a ride. Now, imagine a company that started a restaurant business or they sell just basic everyday necessities. And there is no way they're able to tell exactly what they really have and how much they are selling. So you can actually think about it to say that there's surely going to be a problem in this company. So what do you think this entity can do? One of the things they can try to do would be to probably set up a CCTV. The other thing may be to have an accounting system that can help them track all of the things that they are selling. All of those, think about again, what will a restaurant do? If I were a restaurant owner, I'll try to understand what quantity of rice do I need to produce a plate of rice of probably $10. I need to know. So if I buy a bag of rice, I need to be able to know how many plates of rice I can produce with that. And then I need to be able to say, okay, every single day I'm going to be delivering to my chefs so and so quantity, of rice. Specific measurements. Am I giving them 5 kg today or 2 kg today? How many bags or how many plates of rice can they produce with that? How many plates of food can they produce with a specific quantity of oil? All of those things you use to make food, you need to know what it can deliver so that you can actually price right. You see, I had a friend whom I invested some amount of money in the past week, and he runs a business. And then one day I got into a conversation with him. I said, okay, Oga, tell me, how much does it cost you to make these products? And he doesn't know. And I was like, so what are you doing? What have you been doing all along? And then we spent a lot of time trying to cascade, understand all of the individual cost items, probably about 20 separate ingredients that he uses to produce this item. And after we did, we realized that the unit price is actually less than the cost price. And we had to reevaluate. I told him, see, you need to raise your prices. And that was it. That is what controls can do for you if you can implement controls. Number one is that it helps you get a knowledge of what your business should be doing and also help you to ensure that people are not ripping you off. And then finally, it's important that you create a plan. You have to create a budget. Budget is important. It is like a guide. It's like a master plan for you to navigate, a particular period. So create a budget for your business. Always track that budget if important, if it's necessary, reforecast. But try to make sure that you are looking through your budget to see whether you are operating within what you thought you were going to do. Now, this is my closing statement. I say Operate your startup as if you want to own it for life. However, manage it as if you want to sell it the next day. If you operate your business, your startup very well, you will see that it's going to live and outlive you. And if you manage it very well, you see that if there is need for you to sell tomorrow, you will get real value for it. So there's a lot that we can talk about, but I'm hopeful that this which we have discussed right now will be useful for anyone who listens to it. Thank you so much for coming around. Thank you for listening to me, and I hope you benefited from this conversation. Please do let me know if there's anything you want me to cover. If there's anything you have learned, please just do point it out for me. If there are questions you have, also throw that out for me. And don't forget, this is Finance Boulevard. Thanks again, and let us see you later. Bye.